All right, back to it. It's not add and subtract to both sides. It's doing what?
Can't you add to both sides or add and subtract from one side?
Right, that's exactly right. So we're going to either add 100 to both sides. That'll keep it in balance. Or the other thing is that we can add and subtract to one side to keep things in balance, right? So the same and opposite transaction on one side or the same transaction on both sides. That's how you keep things in balance. So what I'm about to show you, and I will tell you now, we are working on debits and credits. We are working on debits and credits, right? I feel like Yoda telling Luke Skywalker, we are working on a lightsaber. You just don't know it yet. We are working on the Force and the lightsaber. You're right. All right, so we are working on debits and credits. What we are going to do with these transactions, all I want to talk about right now is, does it add or increase or decrease the account? That's it. That's all we're going to talk about. Increasing or decreasing accounts. You're not going to put in the debit credit section yet. Everyone with me? Are you with me? Yes or no?
Yes, sir.
Are you with me?
Yes, sir.
Yes, sir.
All right. You ain't got to say yes, sir. I'm just saying, are you with me? Y'all nodding your head like I'm a rapper. I'm not. All right. So Chaz invests $30,000 cash into a company, right? Now, cash is an asset. We know that because we had the slide that I showed you previously, right? Cash is an asset. So if an investor adds $30,000 cash into a company, the cash in the company does what? Increase or decrease? Increase. So we're going to increase the cash. Now, we also want to increase what other account? When an investor invests in a company, we're going to increase
Equity or common stock?
right, equity. We're going to call it common stock. Because remember, we're going to break out the equity equation. So we're going to call this common stock, capital N. So we're going to increase the cash, and we're going to increase the equity, or common stock. Everyone with me so far? And so how would that look on the accounting equation? It'll look like this. Cash is an asset. It increases 30,000. Common stock, so in the equity, and it increases 30,000. Do we have a balanced equation? Yes. Go ahead.
What's the difference between equity and owner's equity?
What's the difference between equity and owner's equity? I don't know if I should tell you that. Okay. So I'm gonna tell you. I'm hoping this doesn't throw. I'm hoping I'm not throwing too many bits of information. Right? Equity is basically what we use. Equity and stockholders' equity is what we use for corporations. Owner's equity is what we use for smaller organizations, right? And so that's just like nuances in conversation. That makes sense. Everybody with me? Yeah. We're going to talk about that more because some of you might say, well, we got a statement of stockholders' equity, we got a statement of equity, we got a statement of owner's equity, we got a statement of retained earnings. Whatever. They're all for this thing. They're the same second statement that you have to make. But when you change the name, you're signaling something to the external user on how this company is organized. Everybody with me? Great question. Great question. Any question that gives me pause to think I might be giving you too much because I don't want to overload you so quick. I always want to keep it simple in the early going. I just want you to get the simple steps. But a great question. All right. So that is, we're looking at transaction number 2. Company purchased supplies paying $2,500 in cash. Cash is what type of account? Is it an asset, a liability, capital in, capital out, revenue expense? It's an asset. Did we increase or decrease the asset?
Stays the same.
We purchased it, no, first we did cash. I'm talking about cash. Cash is an asset. Right, we purchased, I'm sorry. So cash what? Cash what? Decrease, right. Right, go ahead.
So would it be an increase in supplies and then a decrease in cash?
Okay, supplies. Supplies what type of account?
Asset.
An asset. So you're right, there's an increase in supply. So what did we just do here? We did, huh? No, I'm thinking of, we did an opposite, we did an opposite but equal transaction on one side of the equation. See? We decrease cash, we increase supplies, but both of them are assets. So our account is still in balance at 30,000, but we did an opposite but equal transaction on one side of the equation. Everyone with me? Go ahead.
Do parentheses indicate it's a credit?
Yes, fantastic. Parentheses do indicate a credit. That is fantastic. All right, the next one, next transaction, I keep hitting this keyboard. All right, transaction number 3, we purchased equipment for $26,000 in cash. So cash, what type of account is that? An asset. Did it increase or decrease? Decreased. Okay, good. And we paid out cash for what? Equipment. Equipment is what type of account? Asset. Did it increase or decrease? Increased. Everyone with me? So we're going to have the same situation, an opposite but equal transaction on one side of the equation. But we're still in balance. Everybody with me? I know some of your minds are thinking right now, well, why don't we do this, Professor Jenkins, instead of debits and credits? Wait a minute. We'll get there. Just wait. Yep. Purchase supplies of $7,100 on credit. When we say on credit, we mean a liability. And that liability, at this point, we're going to assume is less than a year. I think we went over this last, which would be a what? Go ahead. Not accounts receivable, accounts payable. Fantastic. Do not fret over those type of mistakes in the early going. That makes sense? It's flipping up receivables and payables, it will happen. You can iron those out about chapter 4 or 5. Does that make sense? As long as you say that, I know you're in the right, you're in the ballpark, you're in the right move. So, okay, so that is supplies, purchase supplies, $7,500 of credit. Credit, did we increase the amount of credit we've taken out or decrease it? Increase. We've taken out more credit. Everyone with me? All right, and we use the credit to buy supplies. Supplies of what type of account? An asset. Did we increase or decrease the amount of supplies we have in the company? Increase. Fantastic. There we go. Everyone with me? Alright. Oh, that's the equation, sorry. So we did the same thing on two sides of the equation. Go ahead.
Is accounts payable and credit like synonymous?
Yes, you're saying the names. Only thing that might change it from an accounts payable to a notes payable is what? Timing.
Longer than you.
Right. Okay, so transaction number 5. We provided consulting services to a customer and received $4,200 cash right away, right? Cash, what type of account is that? Oh, what's your name? No, not you, the person. Huh?
No.
No, right. All right, cash, what type of account is cash? An asset, right? Did we increase or decrease the amount of cash we had in the company? Increase. How do we, oh, I'm sorry. What did we receive the cash for? Services. Services is what? Which of these accounts would we put services in? Revenue. That's exactly right. Revenue. Did we increase or decrease the amount of revenue the company had? Increase. Okay. Increase revenue. Everybody with me? And this is what the equation will look like with that new increase. Look how the accounts payable and the revenue have now increased. You know, those transactions have begun to increase our balance, right? All right, next. Transaction number 6 and 7. Paid rent of $1,000 and salaries of $700 to employees, right? So when we pay these things, we're using what? No. What are we using? Is it cash or credit transaction? Cash. Fantastic. We're using cash in these cases. All right, somebody else's phone went off. We're using cash in these transactions. Cash is what type of account? Asset. Fantastic. Right. And that cash, did it increase or decrease? Decrease. Good. And what did we use cash for? Expenses. Fantastic. Expenses. Rent and salaries, those are expenses, not a liability right now. Now, what will happen is, let's go with the salaries. We talked about this last class. If we have not paid them directly, right, they work the 1st through the 15th, but we pay them on the 31st. During that time, between when they work and the 31st when they get paid, it is a liability. After that, it is no longer a liability. Everybody with me? Good. Let's skip the slide. Oh yeah. Got rent expenses up. When rent expense goes up, what this is saying is the equity goes down. Why? Because rent expense is a negative. That makes sense to the equity. It's minus rent expense. Same thing with dividends, is minus the dividend. As you see, minus dividend, minus the expense. That makes sense? It's a negative to the equity account.
Could you go back a slide?
Mm-hmm. So there's its effect. Transaction number A, provided consulting services of $1,600 and rents facilities for $300 to customers for credit. So here they did it on credit. So what do we call that? When we have given them a product or a service and haven't received the money. Accounts receivable, fantastic. So as you see, accounts receivable is an asset. We're going to increase that asset. What else are we going to do? Consulting revenues is what type of account? Revenue, good. And rents, when it comes to this, it's not rent expense, this is rents, they're renting the facility. So that is also a revenue account. So both of those will increase their respective accounts. Well, both of them in the same account.
So it wouldn't be an expense to rent?
There's rent expense and then there's rents.
That
And what
benefit?
this is rental revenue,
Okay.
right? They're renting out a space, right? In the other example, when it was an expense, they are renting the space from someone
Oh,
else.
Okay, yeah, I said it wrong.
Yeah. This is what it will look like on the transaction, on the equation. All right. The next transaction, right, is that transaction 8, the client pays for their consulting services, right? So they had gotten their consulting services on credit, which is accounts receivable. Now they're going to pay for it, right? When they pay for it, they are increasing the amount of cash we have in the company, and they are paying off their account. When they pay off their credit account, we will decrease the accounts receivable. That makes sense? And both of those are on one side of the equation. So that's what it's going to look like. Increasing cash, decreasing the accounts receivable. All right. Another transaction. Fast Forward pays $900 as a partial payment for supplies purchased on transaction 4. If you reflect back to transaction 4, they bought supplies on credit. Now they're going to pay a part of that bill. Let me say something here, because eventually, well, nah, that's too far. Don't worry about it right now. I'm not going to take you that far forward. Let's just deal with this one. So when you pay a part of the bill, we're going to decrease the cash, and we're going to decrease, our accounts payable. I said increase. It'll look like this. And decrease our cash, and decrease our accounts payable. Now we don't owe $7,100. We owe $6,200. All right, transaction 11 we're gonna pay a dividend to our shareholders. When we pay a dividend is what type of account? Yeah, capital out, yeah, or dividend, right? Either way. So we're going to increase our dividend account, and we're gonna decrease our cash. But what happens when we increase our dividend account? When we increase dividends, we decrease equity. Everybody with me? So we have a negative 200 here, and we have a negative 200 here. This is negative to our equity. All right, that's all the transactions. It's a pretty thorough march through transactions. Last but not least, I would be remiss to not show you the financial statements. And this will be the beginning of you seeing the financial statement. I do not know why the thing is that far upside. But the financial statements, there are four. You have the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. The income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. They have to be done in this order. And this is why. So first, let's talk about the income statement. The income statement gives basically the day-to-day activities of a company, right? I like to think of it as a scoreboard. Since I'm a big football fan, thank you, Jesus, we've made it through another off season. We're here again, back in the holy altar of football. I tend to think of things a lot in those type of sports manners, so I like to think of the income statement as a scoreboard. What has the company done in the last game or the last quarter, right? This is revenues minus expenses. Here in accounting, we will say equals net income. When you say profit, you're using a business term. When you say net income, you're using an accounting term. Everyone with me? Okay. Now you need this number. You need this net income because the net income goes on the next financial statement, which is the statement of retained earnings. It goes here. So the statement of retained earnings is beginning retained earnings plus net income minus dividends equals ending retained earnings. For your midterm, I will make a note now to memorize this statement of retained earnings. It will save you time if you have it memorized. It's just 4 lines. The statement of retained earnings is beginning retained earnings plus the net income. You got to bring the net income over from the income statement. Minus the dividends equals ending retained earnings. Go ahead.
What's retained earnings? Like, what do you mean? What do you mean with retained earnings? Like, what do you have zero over there? What would it be? Retained earnings.
I don't understand the question. When you say which retained earnings, what do you
No,
mean?
what do you mean with retained earnings? Like the first line, what do you mean with that?
This?
Yeah.
Oh, what is retained earnings?
Yeah.
Oh, is the earnings that you carried over from the prior quarter or period. That makes sense? There's profit that you brought over from the last period to the current period minus the dividends, and that is the beginning retained earnings. That's the last period's retained.
So out of these 4 different statements in the balance sheet, so income statements almost weekly or monthly? It's pretty often. Is one quarterly, one strictly yearly? Is one?
Okay, so The financial statements, if you are an external user, are currently quarterly,
Okay,
right?
okay.
Internally, you'll get them a lot faster. You could get them as fast as monthly, but externally, they will be quarterly.
Okay.
And right now, with us doing external financials, we're talking about quarterly statements.
Okay.
And you guys, and I'm glad, great question to bring up, because there is discussion about moving it from quarterly to biannually, right? International markets, they release a lot of their financials biannually. That's not getting a lot of traction in the industry. That's just a conversation that's been espoused by the current administration and the current Congress. Some ideas of bringing down some restrictions, and there have been some people in the industry that have said it might be a good idea, but right now, that is not. I mean, when it comes to the accounting field and many other people, that is not gaining traction at all.
Is it just too hard to keep track of, or is it like taxes, or?
No. Okay, so remember, we're doing these financials to give external users the information they need to make a decision about a company, right? Some of these major companies, 6 months is a lifetime.
Yeah.
I mean, 6 months. I mean, I have I've dealt with companies that have really changed a lot in 6 months. I mean, so 3 months is really a good target in keeping an eye out on a company. I mean, think about it. 6 months ago, I mean, who had a hit song? He's not the same person that has a hit song right now. That makes sense? I mean, who had the top show or whatever? I mean, if you think you're only getting financial information biannually, that means you're only getting 2 reports a year. And God forbid you let a company. I mean, you're talking about billion-dollar companies. You let them run for a year. These companies, what you're experiencing, what you have in your lifetime, is some of the greatest corporations ever invented in the history of man. I mean, they're making more profits than companies that had slaves, and they're paying their employees. I mean, think about that for a second. Just take a second and grasp it. You've got companies like Amazon and Walmart and Exxon and Apple. They are outstripping companies like the East Indian Tea Company and all these other companies that we historically had talked about that had slave labor or didn't pay the majority of their employees or paid them subpar wages. How does that happen? Innovation, productivity, genius, right? With that type of concentration of genius, you need to, I would say you need to keep track on them at least 3 months a year. Every 3 months. I don't think I'm an advocate for every twice a month. That's a little bit too much. But I am an advocate for quarterlies. Because if you let genius go, I mean, you've got brilliant friends, right? Could you imagine letting your brilliant friend say, their parents saying, "Hey, I'll see you in 6 months. Hope this works out for you." And they've got $1 billion. I mean, you might come back and they built a space shuttle. Everybody with me? So, yeah. When it comes back to the great question, Vera, right, on timing, mainly you're going to get quarterlies, and I don't see that changing. Although there's conversation about it changing. And then, and no offense to the president, but him asking us to be more lenient on any federal filing that may impact any institution in his, for me, falls on like deaf ears. That makes sense? Like, you know, I mean, to me, it's like, you know, I don't know, it's like R. Kelly saying we're too strict in our, you know, our laws or something. You're like, yeah, well, you know what, buddy, you're breaking them. You're breaking them. Not quite, you know, not quite the individual I want to come advocate for pulling some stuff back. Anyway, so statement of retained earnings. The ending retained earnings goes on the balance sheet under equity. This balance sheet should look familiar. Assets, liabilities, equity. It's the accounting equation. That'll be the third financial statement. The fourth and final one we're going to make is a statement of cash flows. It's going to be split up in three sections: operating, investing, and financing. Operating, investing, and financing. Everybody with me? And here's your equation. Every chapter will have an equation in the back. This one is return on assets. Return on assets equals net income over average total assets. Average total assets is a tricky thing. When we're doing assets, beginning assets in 2017 are the same thing as ending assets in 2016. The same number on December 31st of 2016 should be the same number on January 1st of 2017. Everybody with me so far? Right? So sometimes they may give you 2017's beginning assets and ending assets. This is like a trick question. They may say the beginning assets of 2017 are $1 billion, and at the ending assets of 2017 are $2 billion. And I've seen students get stumped. They say, "Oh, well, that's just the same year. I'm looking for an average." The truth is, this is ending assets for 2017 or beginning assets for 2018. There's your second year. Or you can think of this as 2017 or ending assets for 2016. There's your second year. That makes sense? So, all in all, you need to add these two together and divide it by 2 to get your average. Don't let them give you two dates. 2 dates if it's the beginning. Only if it's the beginning. If they give you the beginning and the ending of that year, add them together and divide it by 2. Everybody with me? Don't let that go by the wayside. Okay.